Welcome to another episode of Corporate CPR, where we breathe life back into your organization, projects, and processes, giving you insights to recovery and avoiding corporate mortality events. Today, we'll be talking about making finance-driven decisions, and joining us to contribute to the conversation is Paul Barnhurst. Welcome, Paul.
Thank you, Janet. I'm really excited to be here. Happy to be on the show.
Can you share a little bit about your background?
Yeah, of course. So my background primarily is in FP&A. I actually started my career in contracts for the government. Pretty quickly realized I didn't see myself writing government contracts for my life and went back to school. And then after that, I got into a finance role. Opportunity came to do FP&A and been doing it pretty much ever since. That's been almost 15 years ago now. I've worked for a number of large global companies. And a little less than 2 years ago, I started my own business. So today I do coaching, training. I run a couple podcasts and a number of things all around finance and FP&A.
Well, and I know that is a pretty common business term, but since we do have a wide variety of listeners, can you explain what FP&A means?
I figured that was coming. So yes, FP&A stands for financial planning and analysis. And the way I like to tell it is, right, accountants are backward looking. They make sure your books are right, that the historical is correct. Your FP&A professional helps you with the go forward. How are you going to best spend that next dollar, and what does the future look like, and how do you get there?
Excellent. Well, I know you like to geek out on some financial modeling. So let's just start with a little bit of a discussion about, what is financial modeling? Why is it valuable?
Yeah, so at its most basic level, there's a definition I really like by a lady by the name of Danielle Stein-Ferrer. She's an excellent modeler, and she says, basically, if your model's dynamic, you can make adjustments. It has inputs and outputs, and it's helping you make a decision. That's a model. As you really get into it, right, a financial model is some kind of projection of what you think is going to happen. So, I want to know what it would look like if I decided I hire two more or buy two more trucks for my ice cream business, right? What's that going to look like? So somebody puts it down on paper, or in this case, in a spreadsheet, runs all those numbers, makes some assumptions, looks at it and says, okay, if you can do this kind of business, then it makes sense. If you can't, then you're going to lose money, whatever. And so it's basically trying to project what that looks like and help you make an intelligent decision.
Yeah, and so I think I'd like to cover two areas of the conversation for today. And one, just talking about good financial modeling for maybe non-finance people within corporations, as well as then looking at then towards more of the M&A front. So when we're talking about corporations that's established and just operating, why should everyone else care about financial modeling? And is that something you should just be asking your finance department for, or should you be doing some of it yourself?
Yeah, so it's a great question. So I'll break it into two parts. First, I think, there's the whole budget and forecast, which at the end of the day is a financial model. And that should involve the company. Because really, the reason you do that isn't because your budget's going to be right. Because the reality is your budget's going to be wrong. Sorry to break it to you, but nobody's perfect on their budgeting. As I've always said, if I could forecast a budget perfectly, I'd be sitting on a beach or up in the mountains because I'd be a millionaire right now. I wouldn't be working for somebody, right? And so it's really about the process. And that's why it's important it includes the business, because what you're trying to do with that budget and that model is take the strategic plan and the direction and figure out how you get there and what does that mean to the financials. So that involves the salespeople, that involves your marketing people to figure out, okay, what's that marketing budget look like? And what's the return we think we can get? I think often, a lot of businesses like, that's just finance. We don't need to worry about that, just funny numbers. But at the end of the day, good finance professionals should understand the business and the finance, and so they can help you do that planning and have those conversations to ensure you're doing things in a way that protect the capital, the dollars, the investors. Because often people don't think about it. Sales is a great example. If you leave it up to the salespeople to write a quota plan, it's all about how much they sell. Well, what about profit? What if they're selling stuff that's unprofitable? Do you really want to pay a sales guy for that? And I've seen that. I had to step into a commission plan where I think we paid almost $50,000 one month, and we got less than that in revenue over the next year. That's not a long-term, path to success, right? You're going to need CPR pretty quickly if you continue to run the whole business that way.
Right. Well, yeah, I read because we know Reddit is so accurate. I had read a story about how somebody had was doing contract management, and he was putting a lot of rigor even in the small contracts. And the leadership said, we don't want you to waste your time anymore. Just trust the salespeople on those small contracts. And so he did, and then that small contract actually led to a bigger one, and the salespeople guaranteed the client the exact same terms that were in the small one. Well, turns out that it was actually an unprofitable contract, and so the company was definitely performing CPR at that point.
Yeah, exactly. I mean, I've seen that. I was, one time in a director role, and I had to review certain pricing, and turns out the way things had been set up at that point didn't allow me. I could tell them, hey, you can't do this deal, but they'd be like, well, but we already printed it and shared it with the customer and they signed it. I'm like, okay, if I'm supposed to review the pricing, why is our system set up this way? Like, that's a recipe for disaster. And so, I quickly said, okay, we need to fix that, because I want the sales to have that conversation with me so we can model together and make sure it's a win-win for both sides. Like, I have no problem in certain situations if you want to give a discount, but we got to make sure we're protecting the interest of the business, not just, your customer and your commission, so to speak.
Absolutely. So, models are only as good as the data that's received. So let's talk a little bit about how do you even get good data for models, like, talking about maybe let's focus more on one department, right? Like, so if a department is working with the finance team to be able to make sure they're profitable and within budget, et cetera, how do we make sure that we have the right data to be able to predict, some predictions there?
Yeah, it's a challenge every company faces. I think it starts with, you need to make sure you have good financial data, right? And that requires some discipline from your accounting team, in the sense of, are things getting booked correctly? If it's the marketing expenses that go to marketing. And so there's training, there's processes you can do within your systems to first make sure that's right. With the other data, there's data is often a mess. It's one of the biggest challenges. The more you have a commitment company-wide to a culture of data is important, the easier it is to institute those behaviors and to start, working with the teams. But the reality is, often the data is going to be a mess, and your first thing you're going to have to do is work with them to understand it and clean it up. That may be standardizing some customers, because this system spells Delta DELTAIR, this one's Delta Airlines, and this one over here is Delta Inc. Right? We've all seen that type of thing, and that's not uncommon. And in the short term, usually it's a lot of brute force. I mean, yes, there's some automation things you can do to match it, but it's long term, you got to figure out, how do you fix these things at the source? How do you institute good practice for the data? But usually those first few times, as you're working with somebody and there's a mess in the data, it's a little bit of okay, how do we get it cleaned up to do this exercise? Then you need to have those conversations. How do we change processes or fix things so that we have good data next time, and as we continue to make those decisions?
Absolutely. And so, I mean, it sounds like, based off of what you're saying, that it should be very interactive conversation. So, yeah, can you talk to me a little bit about basically what is that back and forth then that goes around to create a great model?
Yeah, so I think what happens is, first, what you need to do is you need to identify, okay, what are we trying to answer? Right? What's the problem statement here? What are we trying to address? From there, you need to give some thought, what's needed based on that in a model. So one of the first things is that design. Okay, what do the outputs need to look like? Then next, you're talking about, what are the assumptions? And that's very collaborative. Okay, well, what do we need to assume inflation looks like? What do we maybe need to assume G&A is? Is it a percentage of revenue? Is it some number off each headcount person? And so you start building out those assumptions. The core model your finance person will do that. And you probably need a 3, depending on what you're doing, but say a 3-statement model. You want that P&L, the cash flow, the balance sheet. That piece isn't necessarily collaborative, in that you're asking them for a bunch of advice there. You're making sure you get the assumptions right, you understand the outputs, and then you can review it with them. And so, I've often heard, a good modeler will spend as much time with the customer as they will in Excel.
Mm-hmm.
And I've found that to be true, often even sometimes more with the customer to really understand it, to ensure it's modeled right versus just the math's right, so to speak.
Right. Right. Well, I do want to make sure we have time to talk about M&A. So let's turn there. So, getting into the M&A business is really, I guess, in my opinion, it's both an art and a science, in that there's a lot of financial decisions you have to make, but the numbers don't tell the whole story. So can you share a little bit about your perspective on what a good M&A strategy is and how finance ties into that?
Yeah, no, I loved how you said the art and science, because I think of the same way with financial modeling. There's some art, there's some science. When it comes to M&A, I think most studies show that the majority of the deals are not accretive to the person who bought it. And so I think obviously it shows it goes far beyond finance. And I think when I think of modeling it and modeling a transaction, working on deals, the first thing is really having an understanding of what's realistic. I think so often people want to do a deal because it gives you revenue growth. You want to make it happen because, oh, I like this company. They have a great name. And so you start to be willing to pay more and more, and you justify it by starting to put in assumptions that aren't realistic. And so I think that's where, not necessarily, what strategy you have, but I think one of the biggest things is really having that discipline.
Right.
And I think someone who's great at that discipline, that's done very well with M&A, is someone like a Warren Buffett, right? He's like, I'm always going to buy I want a great company at the right price. And, if it's a great company at the wrong price, it doesn't do me any good. Right. And so I think it's really important for people to think that way, because I think the biggest thing that gets us in trouble is just making unrealistic assumptions and letting emotions drive us to overpay. I think those are probably the two biggest problems in M&A.
Well, numbers can lie as well, right? So, you get a set of numbers and they tell a certain story, but I guess that story is somewhat based on interpretation. So how do you kind of prevent misinterpreting some of those key numbers that you're looking at?
Sure. So I think there's a couple things. One, it's really important to have that due diligence done, that you get that quality of earnings and make sure you really go through it. It's really, you got to dig through the numbers. That due diligence phase is often several months long, or, at least weeks, if not longer, so that you can spend time really understanding and getting under the covers, right? If all you're looking at is the surface numbers and saying, oh, hey, they're growing, all's good, then buyer beware. Because like you said, there's ways you can move things around to make numbers look better than they really are. It's not hard, right? You make changes. Whatever company's put itself out there that wants to be acquired, they've done everything to present themselves in the best light possible. Not saying they've lied, but they want to put it in the best light possible. Your job is to try to shine a light on it in such a way that you see all those weaknesses, that you see all those cracks. And that can only be done through a lot of analysis, digging in, understanding the customers. Okay, what customers are growing? Do I have a risk because there's a big customer? Okay, what do the products look like? And so, well beyond that, but just, financially digging through that, in addition to looking at every other part of the business. So I think the key there is not getting caught up in the top line numbers and being willing to make sure you do your homework and you dig through it, and just not get caught up in the excitement of, oh, hey, we're going to make a deal. The numbers look good. I really like this guy. Let's get going.
Yeah, absolutely. Well, what are some of the key mistakes you've seen people make then?
Yeah, I seen one, the deal where I remember somebody telling me one time they really wanted to make this deal happen. So they kept layering assumption after assumption. And I asked him, I go, was it a good deal? And he goes, no. He goes, that thing was layered with, how do you put it? He put it, rainbows and unicorns was the word he used. Like, he goes, there was no chance it could ever happen. And fortunately in this case, at that time, they ended up pulling the plug. They ended up doing a deal later. I don't know how that one compared, but, being willing to have those tough conversations can help prevent that.
Mm.
And, example, like if we were looking at, there's one time where a company was being looked at and they were supposed to be, a hyper growth company, and we were seeing all the growth slow. And, they kept just kind of changing the assumptions and kept thinking, we'll structure the deal this way. And if I remember in one meeting going, look, there's a fundamental problem here. The growth isn't what we expect. And someone in the meeting finally spoke up and said, look, why are we even still discussing this? These numbers don't make sense. Let's just stop now. And I was really grateful, because had we gone forward, it would have been one of those where they would have regretted it. They would have never got their value out. And so in that situation, someone spoke up and we prevented the mistake, but we were going down that path. It's a common mistake. Oh, well, let's just take the sales up a little bit. Let's assume that we can do it with 3 people instead of 6 people. We'll just make this assumption over here that our marketing cost will only be 2.5 when it's normally 3. And you start layering them on top of each other to get to an arbitrary number that you started with. And I think that's from a financial standpoint, that's the biggest risk, is somebody's decided you have to get to a certain number. So you keep massaging it till you get there. And by the time you're done, you have something that's unachievable. But nobody wants to speak up and say it's unachievable, because they all want to make the boss happy. And, he wants to go forward. He or she wants to go forward with this. So I think the biggest mistake I've seen, and the biggest problem, is layering in on realistic assumptions to make a number look right, so to speak.
Well, and what about the opposite, I guess? What's some of the best M&A deals you've seen, and what were the attributes that contributed to it working so well, like the repeatable attributes?
Yeah, I mean, I think the best is, one, they've built a robust model. They've done the quality of earnings. They've done a good job during due diligence. And I think the most important thing is they have discipline. And so what I mean by that is being willing to walk away. They have a number in mind, and they know above that number it won't make sense. I think that's the most important thing, to me, is, all right, what's the point that this no longer makes sense? And I've seen us, do that in a few deals. So that's what I think is good. But it starts even before that. We talk the modeling, but I think, if you have a corp dev department and you're looking at M&A, it starts with having somebody that really understands your business and can think strategically. Because at the end of the day, a financial model is a financial model. If the deal doesn't strategically make sense, who cares if it appears to make sense on paper?
Right. Well, what about, when you're part of the strategy, right, of M&A is really to bring more value to your company. And let's assume this company is going to sell in a few years, right? So you're like, oh, we have an exit strategy. Part of our exit strategy, though, we feel like we need to go out and acquire some companies to be more desirable. And obviously the aim there is to gain a higher multiple on the sale. So, I mean, that's how do you know that you're actually, got the right company to get you to that multiple, like that you're analyzing the market the right way?
So, I mean, it's hard. I think first, what you need to do is to have a good understanding of what's gone on around you, what the market thinks as well, knowing all your comparables, having an idea. But I think one of the challenges is you never really know where the market's going, right? And we all know multiples today are not multiples tomorrow, right? A year ago, the valuations or 2 years ago, NFTs were crazy. Now they're worth almost nothing.
Oh, really?
Compared to what they were, they've come down substantially, right? You look at AI valuations are super high right now. Do I expect that to always be the case? Doubtful. So, I mean, part of it is being smart enough to just kind of understand a little bit of the market and those highs and lows and what makes sense. So, if you're looking to grow and you're at a time when multiples are relatively low, okay, that's probably a lot safer deal. You're much better to look out and say, okay, I'm going to take this risk because I know I'm at a point where compared to historically, this industry traded at 15-to-1 multiple, and I'm getting stuff in a 10-to-12 range. That's probably a bargain. And so I think there's some of, really knowing that and understanding that in addition to how they fit strategically. And then being able to structure the deal in such a way that it makes sense. Okay, what's the amount of debt I can have that this business can realistically manage? Because the more you can leverage that, the more you can leverage your return, right? It's why we do LBOs.
Yeah. And so there's a lot of options, obviously, when you go out there. What's kind of the checklist maybe of looking through to pick what are the best options for us? Why I should pick one company over the other. And there's obvious ones, right? And like those top like numbers that you said, but what are some other kind of quick tips to really assess which one's going to be better?
Anything that's software first is really making sure the technology is current. You're not buying a company that has really dated technology, because often a lot of them that are getting sold, that's what they have. There's a lot of founders that like, okay, I've had my 5-year run. I don't want to have to revamp this whole technology. I can sell it right now and I can go start a new company with new technology. It'll be easier. And so I think things like that, I think you really need to understand that. Culture. Is it a good cultural fit? Are there legal risks? This isn't one I worked on, but I remember one where these guys bought a company for about 100 million and the CEO hadn't disclosed something in all of it. And there was a $30 million lawsuit out there. And obviously that's a bad example, or not a bad example, but a case that obviously is going to be a major problem. But I think if I had to say a few things beyond the financial, understanding the technology, making sure the industry is at the right spot. Like, is it growing? Is it declining? What does that mean for my business? So just making sure you understand the economics of the overall market and where it is in that kind of curve, in addition to the technology. And then I think culture is a third and big one, because, M&A, obviously you're going to have to integrate that company. And so is it going to fit culturally? Are you going to be able to do that? How does that look? How does that work? Because often it's easy to figure out, okay, at this point, we'll cut over the 401k plans, the healthcare plans, right? That's all tactical stuff. But really being able to, how do you communicate, ensure that you keep employees comfortable and involved, especially when, right, they expect a layoff to come. Because one of the things that goes into pretty much every M&A deal is some level of reduction of headcount, because you have some duplication, almost always between companies. Well, okay, they got a staff of 8 accountants and we got 6. We could probably get by with 10 total. And you go through and do that everywhere. And so I think, how do you manage that communication and that combination with people being scared? I think that's really important.
Well, it's funny you mentioned scared, because my next question was going to be, obviously M&A can get very emotional. Like there could be a lot of emotional decisions. I just feel this in my gut that this is the right thing. Like, how do you kind of assess that you're making an emotional decision?
Yeah. So for me, from a model standpoint, all I can do is say, look, here's what the model's telling me. I can appreciate, where you're coming from in the gut, but the data from what I'm seeing does not support that. Obviously, as a modeler, rarely are you the decision maker.
Right.
So it's your job to help educate and help try to steer them toward making a smart decision. But at the end of the day, someone else can always say, nope, we're doing it. End of discussion. Okay, but just be aware. So I think the real key for anyone, that's modeling FP&A financial model, and you're dealing in any kind of M&A or even just, investment decisions, is making sure you share what you're seeing and what your concerns are and why your concerns are that way. And then ultimately, at least you're doing everything you can to inform a good decision. There's a quote out there by a guy, he read an article, it was from 1978, and it said, what a CEO wants in a CFO. And number 2 on the list was dispassionate, hard-headed analysis. The idea was, just give me the facts. Don't bring emotion. I look to you to be the numbers guy.
Right.
So I think it's really important that, finance try to remove that emotion as much as they can and make sure everybody just understands what the data is telling them.
Well, but the data doesn't say everything. And this is where I guess I find it kind of difficult looking at companies and acquisitions is, for instance, if I say, okay, I have this product and this other product complements my product, and if I had both of those together, my my revenue is going to increase for whatever reason, like because you're trying to predict the future, because let's say you don't have any other benchmark for that prediction. So what do you do there?
So I think what you do there, and you're exactly right? These are all about predicting the future. So none of the numbers are right. So what do you do? I think that's where scenarios and what if and sensitivities, assigning ranges to things. There's a lot of statistical things you can do to model that can look at it and say, okay, the likeliest combination is somewhere between here and there. And then at the end of the day, you have leadership that are paid a lot of dollars to look at that and, kind of weigh the risk versus the return. Because at the end of the day, there's a risk return payoff, and it comes down to, do we think the return is big enough to take the risk?
Right.
Because no matter how good in your model, no matter how many scenarios you do, like I said, you're going to be wrong. And so in finance, we set out the facts. We say, hey, here's the assumptions we made. Here's the ranges we see. But at the end of the day, the decision has to come down to both quantitative and qualitative.
Well, what about, I guess, then, the other factor that we often see is the blind spots, right? So how do we kind of identify what our blind spots are? It's hard, right? How do you know what you don't know?
Yeah. So I think there's some great things you can do. And one of them is basically having that conversation. How's all the ways this could go wrong? Right? If you're looking at that transaction, making that list, because it forces you to start thinking instead of, okay, how's all the ways that could go right? Or what's all the things we need for this to go right? What are all the things that could go wrong? Okay, what would we do? So I think there's some scenarios, there's some brainstorming, things like that can help. But you also have to make sure you do things to limit confirmation bias. Because we all have a tendency, like 70% of people say they're above average driver. Only 50% of us are going to be above an average.
Right.
Yeah. So
darn those statistics.
I mean, I'm above average. I don't know about everybody
of course
else,
I am too. Well, how about like financial modeling when you're looking more at diversification then, I guess? I know some of my past questions kind of lead to that, but I'm more thinking about diversification, maybe completely outside of your normal industry, and whether or not that actually will add value once combined with your organization.
It's a good question. I've seen companies do it. I think, what you have to ask yourself with something like that is, does it strategically make sense? Because, financials there come down to, if it's a totally different industry and you're buying it as a diversification play, there's generally not a lot of synergies, right? Savings in that area. You're generally not looking at it to enhance anything you're doing today. So a lot of it comes down to, strategically, does this make sense? Is this a good diversification play for us? And there's a lot of judgment there, right? Very subjective. And second is, do the numbers make sense? Is this a business at the right price? And ideally, is it a good or great business at the right price? I think for me, when you're looking at diversification, those are the two really kind of important things, because beyond that, it's not like your typical deal where, I got to integrate it. I got to do this. I got to do this. Maybe you're a portfolio company and you want another holding company. So I think then it's more of a question, is it strategic make fit? Does the market make fit? Is it a market fit? And do the financials make sense?
Disney has an interesting, I guess, kind of acquisition track, with the, first it was Pixar, and then they acquired Fox, and then I'm not sure if they acquired somebody, or I think they acquired somebody to enable platform services like getting Disney Plus. And actually, even though some of these things were very, at the time, may have felt a little niche, especially compared to theme parks and things like that. But basically, then they restructured. But ahead of getting that platform acquisition, they restructured their entire organization to be, theme parks, content, and delivery. And there's that delivery could be made up of multiple things. Have you I guess one, do you have thoughts on that if you have a background there, and two, what other organizations are really kind of maybe got a good track record in the M&A space?
So I think first, talking the good track record in the M&A space, I think, like I said earlier, Berkshire Hathaway, I think they've done a really good job of acquiring companies. On the whole, I think Disney's done a really good job. Like buying ESPN was probably one of the best acquisitions they ever made. They've done others, and then the second, I think, when not integration, but, are you going to do horizontal or vertical thinking about that? I haven't had much experience with that. I worked at a company that had done a lot of it. I wasn't involved in any of it, and a lot of the companies to me didn't fit together. And so it really taught me the importance of making sure you really have where we're going long term, because there were some real challenges in how it all fit together, and a lot of conversation of, would this be better broken apart? And so sometimes it takes somebody with that really clear vision, like some of those people at Disney have had, because that's really hard, vertical and horizontal integration, and trying to say, okay, what does this acquisition mean, right? You're doing theme parks. Also, no, we're going to go buy ABC. Okay. Well, why? Well, because we do movies, right? And someone had to think about that content and go, okay, where's it going long term? So I think that is much more, something that gets into the people that are doing the strategic side than the financial modeling.
Yeah.
You really need somebody that probably has a little bit of luck, but some real foresight to see where things are going, and a real understanding of the market, and that ability to assess it and say, this makes sense, and here's why.
But I guess that's exactly the challenge, right? So you have a person with a vision, but you should be making data-driven decisions, but it's hard to put data to a vision if it hasn't been done before.
It is. And so there are times where, you got the big dreamer that makes stuff happen, even though the numbers will never say should happen. Let's take Elon Musk and Tesla. I don't think any financial model said this is going to work at the beginning, right? We hadn't had a new car company be successful in 50 years in the US or long. I mean, it'd been a long time, but yet you look at the company today and it has a valuation. I mean, it's hundreds, a couple $100 billion, I think, 300 billion. I know it's, I don't know the exact number, could even be higher. It fluctuates quite a bit, but I think that's an example where sometimes somebody's able to, regardless of what all the numbers say, they have that vision and they make it happen. And that's a hard one to say where the right answer lies. I think another good example is FedEx. The guy got a C on his paper in entrepreneurship. And I think it was Wharton or Harvard or something. And the professor's like, nice idea, but it will never work. Doing pretty good today.
Right.
So they're just people that have that vision and that foresight and that willingness to push through no matter what. And if I knew, how to do that or how to always have that answer, I think I could make a lot more money than I am as it goes, or I'd be buying those companies.
Right. Well, but see, I guess I'm thinking, and all the visionaries out there, it goes back to the analogy you gave of the good drivers, right? So all the visionaries out there are probably saying, I'm a good visionary, so the numbers don't matter.
Yeah. And so I think what you need is every company you want that visionary as an owner, and you want the grounded operations person that can counter them. Because if you just let the visionary run, often they'll just run out of steam, so to speak. They'll keep going and they're ahead of themselves and can't make it work financially. So I think, with companies and other things, you also need that person that's grounded and can be a little bit more the realist. And so I think they balance each other is what happens ultimately.
Yeah. Okay. Well, this has been a fun conversation. Do you have 3 things you want to leave top of mind for folks?
Yeah, I mean, I think the first is, at the end of the day, modeling is a decision-making tool. It's not the ultimate decision-making tool. It's one, and it's important to realize it's always going to be wrong. That's the first thing I say. No matter what model you have, it's about going through the process, planning, making good assumptions, and using it to help guide your decisions. But at the end of the day, it's about more than that. So, I mean, I think that's the kind of the first thing. The second thing I would say is I would encourage people to remember, right? Most M&A does not result in a return to the buyer. So make sure you bring discipline to your process and try to remove emotion. Really think about, does this make sense versus getting caught up in, oh, but I'll be able to grow revenue and that will help this quarter, and that short-term mentality. And then I think the third thing I would say is just, make sure you're asking your finance for help and you're making sure they're at the table. I think finance can bring a lot of value, especially when you have somebody in finance that's willing to partner with the business and learn the business. And so those are the three things I would say.
Excellent. Well, it's been a good conversation, Paul. How can folks get in contact with you or find out more about what you do?
Yeah, so a couple ways. They can LinkedIn. I'm on there, Paul Barnhurst. They'll find me there. It's called the FP&A Guy. That's my website, thefpnaguy.com, or as some people like to say, the F Panda Guy, because it's AND. So that's a fun one. And then if anyone's interested, I have a couple podcasts that are out there about FP&A called FP&A Today. And then the second one is all about financial modeling called the Financial Modeler's Corner. So you can find those on all your major platforms.
Excellent. Well, thank you so much for your time.
Thank you. I really appreciate it, Janet. Thanks for having me.
Yeah. And to our audience, until next time, keep your organizations healthy.